All right, I have a chart of the S&P 500 or the ETF that tracks the S&P 500. As you can see, if I was to say, oh, we're having a market crash, the market's crashing, you look at that chart, it just looks like a normal pullback. It's down 8% from its peak and doesn't look like anything that you can call a crash. I mean, it just looks like a pullback. So is this a pullback or are we at the beginning of a crash? You can see Friday's action had some high volume, and I want to show you something that's been going on under the surface. If you're looking at like the triple Qs, the Nasdaq and the S&P 500, you're probably not going to be too convinced that it's a crash and that this is just a normal pullback and an uptrend, and that you should be buying the dip. There's been some crashes happening. Underneath the surface, there's some crashes happening. There's stocks that are down over 50%. I think I seen the Nasdaq, 1/3 of the stocks in the Nasdaq was down over 50%. That's a significant number. That doesn't happen often. So the market action, if you're just looking at the indexes, is hiding what's going on underneath the surface. So the S&P 500, for example, if you look at the holdings of the S&P 500, it's a weighted index. So if you look at the top 10 holdings of the S&P 500, you have Apple, which is just crossed the $3 trillion mark. So when you put money into these 10 stocks, 27% of your money, when you put your money into the S&P 500, when you're supposed to buy 500 stocks, it's a weighted index. So the bigger companies get more of the money. So these 10 stocks that I'm about to mention receive 27% of the money. So Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan. So if those 10 stocks aren't crashing, if those 10 stocks happen to be fighting the trend and are continuing to go up, it's going to hide what's happening underneath the surface. It's going to make it seem that everything's okay, that the market's fine, and the Nasdaq and the S&P 500 and the Nasdaq are still in uptrends. But let's take a look. I mean, the thing that's crashing is tech. Anything that has to do with growth stocks have been crashing. I'm going to take a look at this list here. This list here that I'm about to show you is the 25 stocks that Kathy Woods owns. Kathy Woods has her ARK funds, which was in 2020, she was up 150%. An unbelievable return. And she's invested in all tech stocks. Most of them don't even make a profit. You're buying the stock on what it can do in the future. But at the moment, they don't make money. So Tesla is her biggest holding. Tesla is still in an uptrend, and I think her performance would be a lot worse if it wasn't for Tesla, because everything else she owns has crashed. Like I said, she was up 150% in 2020. In 2021, she was down, I think like 40%, while the S&P 500 was up 26%, to show you how badly she's underperformed, and she's having a rough start to this year. Right, look at these. If you look at these stocks, look at the moves from the peak. Look at this. This is like this reminds me of the dot-com bubble. From 300 down to 72 and still in a downtrend. Zoom from 550 down to 147. Roku, same thing. Significant declines. Coinbase, below its IPO price, down 13% on Friday. And you can just cycle through these stocks, and you can see that there's been some crashes happening in the market. Look at Square, from 280 down to 118. I mean, some of this is unbelievable. The move up and now the move down has been incredible. It's like we're watching history happening right now. You're watching a bubble deflate. The bubble's going to pop. Look at this one. But anyways, you get the idea of it. Seems the growth technology names that were the favorites, the hype stocks, have all been crashing out. So going forward, what do we do? If you believe the market's going to crash, what is it you can do? We'll go to the S&P 500, and I want to show that I did receive a sell signal. Right there, I received a sell signal Friday. This is a weekly chart. The S&P 500 has given me a sell signal. The NASDAQ has given a sell signal. The Russell 2000 has given a sell signal. Gave a sell signal 3 weeks ago. It flipped back and forth for a couple weeks, but now it's decisively below the stop out mark. I mean, you can look at real estate. Real estate has given a sell signal, and I mean, the only one that's looking to be holding is commodities. This is a fund that buys a basket of commodities, which is still in an uptrend. So what do we do? If you believe the market's crashing, and if you go look at the Advisor Perspective website that I posted on another video, and look at the macro view of the markets, we know that the market is overvalued. We have people like Warren Buffett, who's sitting on $150 billion in cash, warning the market's overvalued. He's sitting on cash, waiting for the crash so that he can buy stocks. And I know people say he's old, he doesn't get it, he doesn't get the NFTs, everything's going to be in the metaverse, bro. He's too old. Yep, he's too old. He was too old in the 73, 74 crash, and he bought everything up. He was too old at the dot-com crash when he was sitting in cash, and then he bought everything up in 2003. He was too old with the housing bubble, and then he bought everything up again. So I'm just saying, maybe we should listen to some of these old fuddy-duddies that have been warning us that the market's crazy and it's overvalued, like Charlie Munger, Warren Buffett, even Jeremy Grantham has been warning about how crazy the market has been. So what can you do? So myself, right now, since I got a sell signal on the S&P 500, and that's what I use as a trading filter, I just received a sell signal. One of the easiest things you can do is shift your money from stocks to cash and just sit in cash. That's one of the basic moves you can do, and one of the easiest, which this is what I'm going to be doing. I have a 401k and I don't have options. My only option there is to be long stocks or go cash, and basically nothing else. The options I have in the 401k very limited. I don't have any commodity fund to pick from. I don't have any gold or silver, precious metals to pick from. I don't have any way to go short the market. So my only option is be long stocks or be cash. So this weekend I am putting an order with my 401k funds to move my money over to cash. So that's the first step you can do. And it's one of the easiest ones you can do. Just move over to cash and try to avoid a 20 to 50% decline in the market, which may take 10 years to recover. And just think what happened in 2000. In 2000 it crashed. We didn't reach that peak until 2008, and then it crashed again. You know, it took over 10 years, more than 10 years to overtake that peak from 2000. And if you want to see what happens in a bear market, I suggest you go back and look at the market action from 2000 to 2003 and look at the action that happened. Look at those charts and look at what can happen. The second thing that you can do, if you have a stock portfolio at your brokerage, I'll show you my short-term account. So right now, this is what I own in my short-term account, which happens to be, I owned this, which is an oil company. And I own this is a fund that shorts the market. So this particular fund, SQQQ, shorts the triple Qs. So as the NASDAQ goes down, this should do the opposite and go up. So you can Google inverse funds, inverse ETF funds, and there's a bunch of them. This one, for example, shorts the ARK funds. It shorts Cathie Wood stocks. This one shorts small cap stocks. This one shorts Chinese, the FXI. And this one shorts biotech stocks. And this one shorts the Russell 2000. So as you can tell, I'm pretty much short. I'm short the market. This week's action was very kind to me. Let's just say I profited from the market going down. And I did a scan, and my short-term account is usually trading OBV breakouts. I haven't done any short-term trading on OBV breakouts for the past 6 to 9 months because my scan hasn't produced any results. A signal that the market is overvalued and there's nothing coming up on the scan of everything's breaking down or going into downtrends. This list here is the last scan I did, and most of the stocks in the scan are short inverse funds, ETF. This one shorts the Dow. This is another fund that shorts. This is a gas fund. But as you can see, this is short the Dow, short the S&P 500, short industrials, short the mid-cap 400, short the Russell, short ProShares Ultra Crude Oil. Now this one buys crude oil. Short the retail store. I mean, most of these funds that came up in my scan are short. As you can tell by the names. Ultra short, short, bear. All these that came up in my scans are all short. I mean, and look at some of the volume coming into these. Look at the volume coming into this. Let me change this to a log chart so we can see the action better. It's been building a base for all of 2021, and look at the volume coming in. So, step one, the easiest thing you can do, if you believe the market's going to break down, go cash. Number two, look for short ETFs, funds that short the market, that you will make money on the market going down. Step three is you can actually short stocks. You need a margin account to short stocks. You're not going to be able to do it with a cash account. So for example, I'm going to show you some of the stocks that I am short. I haven't updated this list yet. I closed some of these positions Friday. But these are the individual stocks that I'm short. Meaning I make money when these stocks go down. Most of these, you can just look at Cathy Wood stocks and see which ones look like good shorts. But again, you can see there's complete breakdowns of these stocks happening. I mean, the market is breaking down. Roku, I'm short Roku. I was short Shopify. It went down 14% on Friday, so I made 14%. Short Square, short Teladoc. They're all breaking down. I closed this position on Friday. I was short Netflix, Etsy, so Zoom, short Zoom. So this is just a list of stocks I'm short, and that's your third way that you can make money on a market breaking down. If you don't know what shorting is, I mean, Google it and read into it. You need a margin account, and it's risky because if the stock moves up against you, and you have to have money to cover that account. Because let's say you short a stock at 100 and you think it's going to go to 50. Your broker sells those shares at 100 on the market. He gives you the $100 and he says you owe us 100 shares. If my idea is it's going to go to 50, once it drops to 50, I rebuy those shares for 50 and I return the 100 shares to my broker. But on the flip side, if I short it at 100 and it goes to 150, I owe my broker $50. And at a certain point, your broker is going to give you a margin call. He's going to say, hey, you got to deposit more money to maintain this position, or we're going to have to close out your position. Because the broker's not going to sit there and let the stock go to 200 or 300 or 400 and lose money, and then you say, oh, I can't pay. And then they're responsible for that loss. So that's why you have to open up a margin account to short stocks, and you're responsible for any losses if the stock moves against you. And this is what happened with the whole GameStop thing. It was a short squeeze against people that were extremely short, hedge funds that got greedy and shorted more stocks that were available. And that's the whole point of a short squeeze. But what I want to bring to the attention is a lot of these stocks that are short, I would not be surprised if we get a rally here. Because we're getting to a point where the market's getting a little bit oversold. If you can see from this histogram on the bottom of my chart, that shows how far away the stock price is from the 200-day moving average. And like I said, the 200-day moving average kind of acts like a magnet. On the way up, it tends to pull it back down from time to time. And on the way down, it's going to tend to pull it up from time to time. That's the one way to look at it. And as you can see, like PayPal, for example, we are the furthest we've ever been away from the 200-day moving average. So I wouldn't, and we're getting, Friday sell-off came with significant more volume than usual. So I wouldn't be surprised if next week we get a rally. But just like on uptrends, people, when you're convinced that the stock's in an uptrend, you're going to buy the dip. If you're convinced that the market has changed and we're now entering a bear market, then you should be fading the rip or short the rally. If I get these stocks, I'm going to be putting hard stop orders in them, and I get stopped out, and we get a rally back up to this stock, for example, if we get back up to 200, 220, and if it gets up to this gap around 220, I'm going to be eyeing these stocks to short them again. I'm going to be fading the rip, short the rallies. And a lot of these stocks, like Spotify, it looks like it's just breaking down, just starting to break down, breaking the support. But a lot of these stocks look like they're oversold. Like C Limited looks like it's oversold. So I would not be surprised if we get a rally next week, a short-term rally on some of these stocks. It doesn't mean I think it's time to buy. I think this bull market's over. We are now entering a bear market. That's what I believe. What would make me change my mind? Well, if I see some of these charts, if I see these charts break up and they go past the 200-day moving average, if they reach, we're looking at Zoom right now, if this breaks up and somehow reaches 400 and it breaks through that, then I will say, okay, then this was just the dip and the craziness is gonna continue. I don't think that's gonna happen, but anything's possible. What do I be looking at? The Federal Reserve is talking about raising his interest rates. And the markets, look at the way the markets are reacting just by the Fed talking about raising interest rates. They haven't even raised interest rates yet. They're tapering their bond purchases. They're tapering the amount of money that is in the market. And the market's already reacting by selling off. If the Fed comes out and says, hey, we're wrong, we're going to save the market, we're going to save Wall Street, we're going to print more money, we're going to print just as much money as we did in 2020 with the pandemic, then I'm going to change my mind and say, okay, then we're going to get crazy again. Don't fight the Fed, and they're pouring money into the market again. Or if Congress starts handing out money to people again, if we start getting stimulus money for free money, that might make me change my mind. If we see the Build Back Better plan pass, which it hasn't been able to pass, things like that is what I'm going to keep an eye on. But right now, the theme of the market is it's going down. We need to start looking at going cash or short the market. And if you are going to buy any stocks, I would focus on value stocks. I would focus on commodity-based stocks because I believe commodities, inflation's getting out of control. We're at 30-year highs with inflation. And that's if you believe their numbers. And I would be looking to buy commodity-based stocks. I'm going to show you my long-term portfolio. Keep in mind, I usually own 40 stocks in this portfolio. As you can see, I don't have anywhere near 40. I've been liquidating my stocks the past 3 weeks as I've been getting sell signals. But as you can see, I don't really own any tech. AutoZone. This is a chemical company. This is an ETF that buys live cattle. DBC is a commodity fund. This is an ETF that buys the energy stocks. This fund buys coffee. So I'm shifting my portfolio over to commodity-based businesses or the commodity ETFs that buy the commodities themselves. This is a shipping stock. Silver, I just bought silver this week, and I'm also buying gold. So if I would look for businesses that have pricing power, people still have to buy food. I would look at groceries. I would look at commodity-based stocks. I would look at now let me go to my sectors and then just give you some ideas. I would look at agricultural chemicals, chemicals in general. That's going to be a stock that should hold up during a crash. Energy, just start looking at some of your energy stocks, especially if crude oil keeps going up. Keep an eye on what's going on in Ukraine and Russia. If Russia does invade, I believe natural gas is going to go up. You can also buy UNG, which is an ETF that buys natural gas. So you can just Google up ETFs that buy commodities, and you should get a list. Same thing with manufacturing. Look for farm and construction, because if metals keep going up, agricultural products go up because of inflation, then equipment makers of that equipment should go up also. Obviously, metal and miners, like take the EV for example. I would rather buy a lithium miner than an EV manufacturer, like Tesla. I'm short Tesla, by the way. I would rather buy the supplier of lithium to Tesla that's going to have pricing power than to buy Tesla, which is going to be facing competition, and it's way overvalued. It's been overvalued for a while, but that's just my opinion. So I'm just giving some ideas on what to do if the market's breaking down, if you look outside the S&P 500 and the NASDAQ, if you just look at Cathie Wood stocks, and you'll see stocks that are breaking down. I have a list here of let me tell you, this is the list I'm using right now basically these are stocks I'm looking at to short. There's Tesla, Roku. I mean, you can see a lot of them are Cathie Wood stocks. I mean, here you go, a mattress company, Purple, breaking down. But you can just, even Disney has breaking down. I tried to short this one, but my limit order didn't get filled. It gapped down, and I don't like to enter trades with a gap. If you look at my past video about gappers, I know the video was talking about stocks that gapped up, but the same theory happens when you're short on a stock. You don't want to short a stock when it gaps down. In this case, in Disney's case, it still would have worked out for you. You would have made money, but I tried to avoid gaps because most of the move has already happened on the overnight session, and it gaps at the open of the market. Chewy, it's breaking down. I mean, there's just the whole market starts crashing. It doesn't matter if it's value, even commodity-based stocks are going to go down. They're just not going to go down as much as the growth tech stocks, the profitless tech, let's call it. But you can see here, there's Intuit's another stock that looks like it's about to break down. And I'm going to be eyeing these stocks. This is my watch list of stocks I want to short. And if we get a rally, like I'm expecting in the next week or two, I expect the rally is just going to be a short-term rally off of oversold conditions. And it's going to provide an opportunity to short the stocks that hit resistance points. So, just a thought on what to do and what I'm doing. I'll show you my long portfolio again. I got some sell signals on these on Friday too. So now that the S&P has given a sell signal, I will not be buying any more stocks. On my long portfolio, I'm not buying any stocks. On my 401k, I don't have an option to go short. I'm going cash. I built up a cash position on my portfolio, but here we go. AAP. These are whatever you see a red bar on is what I received a sell signal on. So I'm going to be getting out of a few more stocks on this portfolio on Monday. I'm going to be exiting this position. This one too. I was loaded up on a bunch of semiconductors. I got stopped in the past three weeks. I have been liquidating a lot of the semiconductor stocks. So as you can see, I got a few stocks I need to liquidate, and with the S&P now, the S&P 500 now giving me a sell signal, I will remain out of the market until this flips and turns green again. I suspect it's not going to be turning green anytime soon. That's just a suspicion, but who knows? Part of the trend following system is you don't know what's going to happen. You don't really predict. You just see what's happening and react. So that's it. I'm going to leave it at that, and hopefully gave some of you some ideas of what to do. And let me just zoom out on this S&P 500. And just remember, 2000 top, 2008 top, it took what? 2013, sometime in 2013, it took, if you were in the market in 2000, it took 13 years for you to regain that position. So just keep that in mind. Just look at the way the S&P 500 is. Look how high it is. I mean, a pullback down to pre-pandemic levels. I mean, that's not something that's not unbelievable. It could easily happen. I mean, look at this. And then in 2008, it retested that low again. So just keep that in mind. Just because the market's been going up, and maybe you've been in the market for the past 2 to 3 years, and buying the dip strategy has always worked, it doesn't mean it's always worked. Ask people in Japan. Look at the Japanese market that peaked in 1990. They still haven't taken out their 1990 peak. Ask them if buying the dip always works. And even our own stock market, there's been periods of underperformance if you bought at the wrong time. So buying the dip and buying and holding, not a good strategy. Not a good strategy when you're on the market that's overvalued. Every indicator you read, go to the macro, go to advisor perspectives, and look at some of those macro charts. Every indicator mathematically shows that we are going to have negative returns for the next 10 years. Inflation is at 30-year highs. I don't know if the Fed's going to be able to cut interest rates again. If they cut interest rates, then inflation is going to get out of control. So it's either they save Wall Street and fuck Main Street, or they're going to save Main Street by raising interest rates to control inflation and let the market drop. And a lot of insiders have been dumping. They've been dumping at record numbers. So take that for what it's worth, and don't be left holding the bag.